There are over 300 candlestick patterns. Traders spend months trying to memorize them, but most of them are still losing money. Here's the truth nobody tells you. 99% of those patterns are just noise, and most people freeze up when the chart is moving. Because the real question is, should you buy, sell, or wait? In this video, I will teach you what candlesticks are and real-life examples on how to implement them. That way, you can confidently analyze chart patterns, price direction, and become a more successful trader. Let's go. If this is helping you read the markets with more clarity, hit like, share it with a trader who needs this, and subscribe for more practical trading lessons. There are two types of candles: green candles and red candles. Red candlesticks are bearish as price closed lower than it opened. This signals that sellers are stronger than buyers. For red candles, the top of the body shows the opening price while the bottom marks the closing price. Green candlesticks are known as bullish candles as price closed higher than it opened. Buyers were in control. For green candles, it is the opposite, as the opening is at the bottom of the body and the close is at the top of the body. The wicks show the highest and lowest prices the asset reached in that time period. Let's now compare candlesticks with big versus small bodies. The size of the body reveals a lot about the strength of buyers and sellers. For example, for a green candle with a large body, buyers were in control. This is because price opened at a lower level, and strong buying pressure pushed the candle to close at a much higher price. Similarly, a red candle with a large body shows that sellers were in control as they managed to push price down sharply before the candle closed. Candles with small bodies show indecisiveness and resistance from both sides. A green candle with a small body shows that buyers were slightly stronger, while a red candle with a small body shows that sellers had a slight edge. Understanding the different sizes of candle bodies and wicks gives us important information on the direction and strength of price movement, which is essential when analyzing the market. Now, let me show you the top 3 candlestick patterns that I find most effective. Let's start with one of the most popular candlestick patterns, the engulfing candle. But first, just to be clear, most beginners read this pattern the wrong way. They see one big candle swallowing another candle and immediately think, reversal confirmed. That is not how this pattern should be used. An engulfing pattern is made up of 2 candles. The first candle is smaller. The second candle is larger, moves in the opposite direction, and completely swallows the body of the first candle. The important word here is body. The main focus is not whether every wick is swallowed. What matters most is whether the second candle's body clearly engulfs the previous candle's body. That gives traders an important clue. It suggests that the pressure from the first candle may have been overwhelmed. But this does not mean price will definitely reverse. It simply means there may be a shift in pressure, especially when the pattern appears at a meaningful location. There are 2 types of engulfing candles: bullish engulfing and bearish engulfing. A bullish engulfing pattern forms when a smaller bearish candle is followed by a larger bullish candle. In simple terms, sellers were in control first, but buyers then stepped in with enough strength to take back control. Now look at this real chart example. Price moves down into a support area. Sellers push lower, but then a bullish engulfing candle forms. This does not guarantee that price will reverse. But because it appears near support, it adds weight to the idea that selling pressure may be weakening and buyers may be stepping in. Now, here is the opposite. A bearish engulfing pattern forms when a smaller bullish candle is followed by a larger bearish candle. This means buyers were pushing price up, but sellers came in stronger and overwhelmed that move. In this chart example, price pushes into a resistance area. Then a bearish engulfing candle forms. Again, this does not mean price must reverse, but when it happens at resistance, it suggests that buying pressure may be fading and sellers may be gaining control. So the key lesson is this: an engulfing candle by itself is not sufficient to enter a trade. Relying on such a pattern in the middle of nowhere is a weak thesis. But an engulfing candle at support, resistance, or after an extended move carries more weight. That is how engulfing candles should be read. Not as guaranteed signals, but as confluence that pressure may be shifting. Next, we have the Doji candlestick pattern. Doji candlesticks are easy to spot as they have an almost non-existent body and wicks on each side, making it look like a cross or a plus sign. Doji candlesticks form when opening price and closing price are almost the same, signaling indecision. However, that does not mean the market is automatically going to reverse. Let us look at a real chart example. Here, we have a strong downtrend with price falling sharply. Right here, a green doji candlestick appears. This is a sign that price could potentially reverse. A bonus tip is to wait for confirmation candles after the doji candlestick to appear before entering the trade. In this case, two green hammer candles appear after the doji candle and boom, price completely reverses. Last but not least, we have momentum candles, which are the easiest to spot. It is usually at least 2 to 3 times bigger than previous candles. A momentum candle is a strong candle with a large body and very small wicks. This means price moved strongly in one direction and closed near the high or near the low. It signals a strong, aggressive shift in price driven by heavy buying or selling. These candles indicate that one side is firmly in control, reflecting a sudden acceleration in the market. A momentum candle is extremely useful in markets that are choppy. When price is moving sideways without any clear direction, a strong momentum candle can be a good indication that price is breaking out of the range. On top of the 3 most effective patterns, we now want to give one other useful pattern and bonus tips for all those that made it to the end of the video. This last pattern is the tweezer candlestick pattern. It consists of 2 side-by-side candlesticks that resemble a pair of tweezers. They often signal a loss of strength and potential change in market direction. The first candle is a part of a prior move, which still shows momentum. The second candle opens and closes near the same price as the first candle, showing the trend is losing steam. Tweezer patterns are best used at key price levels and are especially effective when deployed as confirmation alongside support and resistance. The 2 main types of tweezer patterns are tweezer tops and bottoms. In a tweezer top, price pushes higher, but both candles reject around the same high. This can suggest that buyers are starting to lose control, especially if it appears after an uptrend. In a tweezer bottom, price pushes lower, but both candles reject around the same low. This can suggest that sellers are losing control, especially if it appears after a downtrend. One key detail is that the candles do not need to look exactly identical. What matters is that price tests the same area twice, but fails to continue through it. Before you start applying these candlestick patterns in the market, remember this: no pattern should be treated as a standalone entry signal. Candlestick patterns become much more useful when they appear in the right context, especially when they line up with other forms of confluence such as support and resistance, market structure, trend direction, moving averages, and proper risk management. Here, we are looking at the Euro-USD chart on the 1-hour time frame. The pink circles highlight a clear sequence of lower highs and lower lows, confirming that the market structure is bearish. Price is also trading around the 9-period exponential moving average. In a downtrend, the EMA can act as a dynamic resistance area where price pulls back before continuing lower. Now focus on the orange circle. This is where candlestick confluence becomes important. We first see a doji candle with a longer lower wick, showing that sellers pushed price down, but buyers stepped in and rejected those lower levels. This reflects hesitation and indecision in the market. Shortly afterwards, an engulfing candle forms, suggesting that sellers are stepping back in and regaining control. On its own, that candle is not enough. But when it appears together with bearish market structure, lower highs, lower lows, and rejection around the EMA, the signal becomes much stronger. The key takeaway is simple: do not trade candlestick patterns in isolation. Always consider the overall market structure and confluence. I hope you enjoyed this video and learned something new. If you did, please like and subscribe so our team can continue to provide free content for you. Thanks for watching, and see you in the next one.